So the stock market, I think, is heading in a pretty dangerous direction, and it's making me quite scared, especially for new investors. Let me tell you why. Firstly, we have the fact that the American stock market, and in particular the S&P 500, is actually quite expensive. The Shiller PE, which measures, the price to earnings ratio going over a few years, is now at around 33, which, looking at this graph historically, it's getting pretty high. We've not really seen these highs for quite a long time. So this reason alone suggests that the market is too expensive, which means that it's gonna, crash and go down eventually to kind of rectify that overall price to earnings ratio. Reason number two is everything that's happening at the moment with Gamestop and AMC and all those Wall Street bet stocks that have just gone through the roof because, people are grouping together, hoping to make some really quick gains. And I'm not going to get into detail about what happened. If you're interested and somehow you've been living under a rock, here's a video by Gamestop where he explains everything really, really well. But the worrying thing, in my opinion, about all of this is that obviously people have got an appetite for quick gains and making a lot of money very quickly, which again is worrying. That is definitely not what I talk about in this channel. I always go for long-term investing and getting rich, getting wealthy over a very long period of time, because that's a lot more doable than getting rich quick, like with GameStop stock or stonk. And this leads me to the third reason why I am fearful about the market and what's going to happen to individual investors in the short term. And that is because everything's gone up a lot. You look at the S&P 500 over the last year, it's ridiculous how quickly it's grown, considering that, there's still a pandemic in the world. We still haven't gone past the pandemic. Companies still haven't recovered to their, pre-pandemic levels in terms of earnings, at least for most companies that are not tech stocks. Plus the fact that the news are peppered with all this news about really quick gains and look, I've made 20 million in a few months, right? All of those things are just getting new investors to enter the market. And my worry is that when people enter the market and they buy a really hot stock or perhaps even buy the index now, they're probably going to experience losses in the short term, right? Obviously, those are paper losses, which won't necessarily materialize unless those investors sell those stocks. However, I worry that people are going into this with the wrong mentality, and as soon as they're making a loss, they're gonna sell, and then they're gonna tell their friends that the stock market is a dangerous world. So having said all that, okay, that was a bit of a long-winded introduction. The reason I'm making this video is that there is still value to be found in the stock market. It's very difficult to find value, okay, let's be honest. I've not bought stocks for quite a while now because I'm just not finding value. I'm just not really finding companies at a deep discount, especially high quality companies. It's quite difficult to find value. But I have found one company, one stock, one dividend growth stock that I feel is going against everything that's happening in the market, okay? It's not an exciting stock. It's actually a really boring company, okay? No offense to anyone, but it's very boring. It's a very small company. However, it's a really high quality company. It's a really high quality business, and it appears significantly undervalued. So if you're interested in knowing what this company is and then reasons why perhaps you should buy it or not buy it, okay? Stick around till the end of the video because I'm gonna cover all of that, okay? Let's finally begin this video. Hey guys, welcome to the Escaping to Freedom YouTube channel. In this channel, we talk about long-term investing, specifically dividend growth investing. This is the strategy that I am personally following. I've got pretty much my entire net worth in dividend growth stocks. Those are stocks that increase how much dividend they pay you every single year for many, many years. And the stock we're going to talk about in today's video is one of those stocks. And like I said earlier in this video, everything's very expensive, okay? And my personal investing philosophy is that you shouldn't just go out there and buy a stock at any price, because even buying a great company at a wrong price can actually be a pretty poor investment, okay? Even though the company is really high quality, if you buy it at too high a price, and then something happens to the company or the stock crashes, it might actually take you quite a few number of years to even make your money back, okay? So I think valuation is very, very important. You should always look to buy stocks that are at least at an attractive valuation, at least at fair price. If a great stock is at fair price or below, then that's when I recommend you buy. And by the way, none of this is investment advice, okay? This is a little disclaimer. I'm just a guy on YouTube that knows quite a lot about investment, knows quite a lot about building tools for investors. However, this is just my opinion, okay? These are not recommendations for buying or selling, okay? So with that out of the way, let me tell you what this company, let me tell you what this stock is actually called. It's called First Source Corporation. So now we're getting into the meat of the video. Now, the way I like to structure these like deep dives into companies is that I first like to tell you what the company does, because that's the most basic thing, you know, how does a company make its money? Then I'm going to show you its past performance, you know, how well it's done over time compared to the S&P 500 as well, because I think that's quite a good thing to do, you know, compare it to what your money would have done had you just invested in an index. Then I'm going to show you some of the highlight fundamentals, you know, the reasons why I think it's such a strong company. Then I'm going to show you what kind of valuation it's got, you know, how cheap it is or how expensive it is, but in this case it's not expensive. And then finally, my personal thoughts on the company. So if you appreciate the hard work that goes into these videos, then I would really appreciate a like on this video and subscribe to this channel if you haven't done that already, if you're not subscribed already, because I release videos like this one right now every single week, all about dividend growth investing, personal finance, and just basically growing your wealth, okay? Because that's what we all want, really, isn't it? So let's get started with what First Source Corporation actually does. Okay, let's begin with the basics. What does First Source Corporation actually do? Well, basically it's a bank, okay? It's a chain of banks that are actually all located in quite a small area near Michigan. And actually there's one in Sarasota, Florida as well. So they haven't got many branches. It's actually quite a small regional bank, and I will guess that unless you live near there, you probably have never even heard of First Source Corporation. At least I hadn't heard about it. So I'm just scrolling through their investors presentation that they always, you know, give out with their annual reports and their quarterly reports. And this is a great place, by the way, if you want to get a feeling for a company, what their kind of values are, what the management of the company actually values. And it also gives you some pretty cool key data that's really important to know. Now, in the case of First Source Corporation, you know, it's important to know what the business is, how they make money. So 56% of their revenue comes from both business and personal community banking, but also they've got some specialty finance, which I guess means, you know, giving out money to other fields. I think, here we go. So aircraft division, construction equipment division, you know, they obviously offer loans for quite specific purposes. I also really like that they have a very experienced executive team. That's actually often quite important, and it's not often kind of looked at too much in investing, but if the management team, especially the executives, have been there for a very long period of time, it actually means that they're doing a good job. Because remember, executives are actually chosen by investors. So if an executive is not doing a good job, the investors can actually vote them out and vote someone else in. So the fact that they've been there for 38 years on average is actually a pretty good sign. Now, something that I don't super like about this company personally is how small it is. Its market cap is around $1 billion, which is fine. It's definitely, you know, it is small cap, but it's not massive. And, you know, have a look. It's only got 78 banking centers and 99 ATMs, okay? It's a very small scale operation. However, as you'll see in a minute, it's actually very well run. So what I like to do with companies when I'm, you know, analyzing them and I'm also tracking them in my own portfolio is to check whether they've performed better or worse or equal to the S&P 500 or whatever the index is that those companies trade in. Because if it doesn't perform better than the index, this might perhaps make you reconsider even buying that company, okay? Now, in the case of First Source Corporation, have a look on your screen right now. This is the performance that it's giving you. Now, this goes back 20 years, and it assumes that you invested $10,000 at the very beginning in both whatever company you put in and SPY, which is, you know, how a lot of people invest in the S&P 500. Now, this is a new feature that I've been coding within Dividend Compass. Now, every company that is in there is going to have this comparison, so you can very quickly see, you know, its past performance compared to the index. So if you want to check Dividend Compass out, there's going to be a link in the description below. So basically, it's very easy to see that First Source Corporation has actually outperformed the S&P 500 at pretty much all times. In fact, for 97.1% of the time, it's actually giving you more performance than the index. Sometimes it's actually significantly higher, almost double. And actually pre-pandemic crash, it was doing a lot better than the S&P 500. Now, you'll notice here that it's not quite recovered to the previous levels, whilst the S&P 500 actually has. But what I want you to focus on here is the fact that you would have earned way more dividends with First Source Corporation. In fact, $12,000 more or less, compared to $7,000 with SPY. Obviously, past performance doesn't necessarily mean future performance, right? But when you look at this and when you look at a company that seems to be well run, there's not really any reason to believe that they cannot keep doing this for, you know, at least the next 5, 10, 20 years. At least that's what I believe. But just to see how good the company actually is, let's now have a look at some of the data that you might be interested in about the company, as well as the fundamentals. All right, here we go. First Source Corporation. As I said before, it's got a market cap of 1 billion, right? But the really key factor here is the dividends. This company, guys, is a dividend champion, which means that it has a dividend growth streak. That means that it's been increasing its dividends every year for the last 32 years, or since 1989. And this is actually how I even found this company. I went into Dividend Compass, chose the Dividend Champions list, okay? And I then sorted by value grade, all right? And out of those, I kind of had a look at a few of them, but here we go. First Source Corporation came out here. Instantly, I liked the dividend growth rate. I liked the payout ratio, very, very low, and the yield was pretty good. So, you know, clicked on it, and that's how I got to this, and I was able to really kind of gauge the quality of the company. So yeah, very quickly, it's got a dividend yield of around 3%, which is pretty good. Payout ratio of only 34%, which is great. I always want to see that payout ratio be as low as possible, okay? Definitely below 60% is like the limit that I like to see. Sometimes I'll invest in stocks that have a payout ratio of 70% perhaps. Non-REIT stocks, by the way, of course, because those have, you know, a much higher payout ratio. But yeah, 34% is very good. At the moment, the PE ratio using forward earnings is around 12, which, you know, objectively is pretty good. We're going to compare this PE ratio with its last PE ratio in a second. And then, yeah, debt to equity and interest coverage. Those aren't really relevant when you look at banks, okay? So I'm going to ignore those two. And then I can see here that return on equity is, it's yellow, which means it's okay, but it's not amazing. Now let me show you what the dividend has done over time, okay? Here we go. This is, let's deactivate earnings per share. This is this company's dividend over the last 20 years, all right? This is basically the overall dividend for every year, and then how much that increased year by year, okay? So for example, in 2006, you know, the overall dividend was 20% higher than the year before that, okay? And yeah, you can see that the dividend growth rate of this company definitely varies depending on the time, okay? I assume that there's times when the company is doing a lot better, like in 2018 and 2019, they grew their dividend very aggressively those 2 years. But otherwise, there's periods, you know, after the Great Recession where it grew its dividend quite modestly, okay? But that's the important thing about these companies, guys. They still grew the dividend, even though this was a bank, okay? And banks really struggled during the financial crisis, but it still was able to increase its dividend. Now, I'm gonna change this to quarterly increases, okay? Those are the actual increases to the quarterly dividend, the things that the company announces, okay? You'll actually notice that quite a few of the years, they don't increase their dividend that year, okay? For example, in 2016, you know, that dividend was 18 cents for every single one of their payments. It wasn't increased. However, dividend growth streaks are not counted by quarterly increases. They're actually counted by annual overall dividend, okay? So here, you're actually gonna notice that they actually decreased the quarterly dividend in 2020. They decreased it by just 1 cent per quarter. That was in February. It went down from 29 cents to 28 cents, okay? Now, normally this would be a really, really bad sign. I don't like to see companies slash the dividend. However, they kind of know what they're doing, and actually they've been able to rectify that, okay? You can see that they paid 3 different payments of 28 cents per share, okay? However, the next dividend that they're gonna pay, which is gonna be paid on the 12th of February, but that is already back up to 29 cents per share, okay? So as long as they pay 29 cents per share, every single quarter in 2020, then the overall dividend for 2021 will still be ever so slightly higher than 2020, and they will be able to keep going with that dividend growth streak, okay? I hope that makes sense. Let me know in the comments if you'd like me to make a video about dividend growth streaks or just to explain this a bit better, okay? Just let me know in the comments, and also like this video as well, because you know, if you appreciate videos like this, do that. It really, really helps me and my channel a lot more than you think. So yeah, the main takeaway point here, guys, is that the dividend growth rate of this company is pretty good. Over the last few years, it's been higher than the average, okay? Over the last 3 years, we've got a 14% per year dividend growth rate, which is phenomenal. But over the last 20 years, the average has been 7.3, which is still great, by the way, okay? A dividend growth rate of 7% means that your dividend income from that company is gonna double every 10 years or so on average, which is phenomenal, right? Your job certainly will not give you such great pay rises. Now, if we superimpose the earnings per share of this company, we can actually see something that I really, really love, all right? And it's that the payout ratio, it's now sitting at 34%. Okay, it was the same in 2020, but it's never really been that high. It kind of hovers around 30%. That's obviously where the company like to have the payout ratio. And notice that their earnings didn't actually drop that much in 2020, right? They went from $3.50 to $3.30. Definitely a significant, drop, but nothing too massive, and definitely nothing to actually affect the dividend. If we go even further back, we can see that the highest payout ratio that they had was in 2009, in the depths of the financial crisis, and even then it was at 75%, which is definitely a little high, but nothing too crazy. So yeah, guys, I really like this. The earnings are growing at quite a nice rate. The dividends are growing also at quite a nice rate. So far, so good with First Source Corporation. Now let's scroll down a little bit and let me actually show you the valuation, okay? How much would be a good amount to pay to buy this stock, okay? So what I like to do is I like to compare several metrics. Now, something that I really like to do is to see how the current dividend yield compares to the overall company's dividend yield over the last few years. And in this case, the yield that you can get now is actually quite a lot higher than it has been for the last few years, Overall, it's been around kind of 2.3%. That's been the average dividend yield. For ages, it was below 2%. Then it went up a bit, okay, because the stock price went down. It started to suffer, and during the pandemic crisis, it got as high as 4%. I believe, 4.13%. That's pretty cool for a company that normally pays a lower dividend. But still, what's more relevant is that the current dividend yield is 3%, which is a good starting dividend yield. Now, the same thing can be said with the PE ratio, right? The PE ratio of the company is significantly lower than it has been, over the last 5 years, which is good. It suggests that you might be able to get, a cheaper price for the same quality company. Okay, then if we have a look at what analysts are saying, okay, this is not many analysts, only 3 analysts, but they reckon a fair price for this stock is $43, which is kind of in line with what price the PE ratio and the yield difference techniques give us, okay, compared to the price of 39 at the moment. And if we just do a real quick dividend discount model calculation, I'm just gonna go for a 6.5% dividend growth rate, considering that the average over the last 20 years has been over 7%, okay? I always like to go a little bit lower just to have a nicer margin of safety. And we're gonna go for a discount rate of 10% because that's the return that I always look for, 10% per year. And if we calculate that, that actually suggests that it's actually maybe a little bit too expensive, okay? So it depends kind of which metric you trust more, all right? You can always change this to 6.7%. That will be closer to the price. But overall, guys, all these metrics seem to suggest that First Source Corporation might be slightly undervalued, okay? You're not getting a steal here, okay? But considering that the market is so expensive, now is not a great time to find steals, okay? I honestly haven't found that many, but all these metrics suggest that First Source Corporation might actually be at either fair price or slightly under. Okay, let's keep scrolling down and let's have a quick look at the fundamentals, all right? So as we saw earlier, the payout ratio using earnings per share, really good, kind of around 30%. Now, actually the free cash flow payout ratio, which a lot of people prefer to use, okay, because dividends actually come out of free cash flow, That's actually even lower than the earnings per ratio. You know, it's around 20% per year. The number of shares is kind of flat. Okay, it's decreased ever so slightly, but you know, it's flat. They're not a company that buy back their own shares, which is something that I do like to see, and we don't get that with this company. So that's definitely, it could be better, okay, in this situation. Then the return on equity, it's kind of like borderline okay. You know, I normally go for a 10% return on equity. For banks, if it's a little bit lower, it's normally okay. But you know, the average is 9.5. Okay, we're basically at that 10% return on equity. But if you decide to invest in this company, just you know, keep this in mind. It's not a wildly profitable corporation. Okay, it's kind of conservative. It's run well, but you're not gonna get insane returns on equity. However, having said all that, these two things that I'm going to show you now are really good. Okay, the revenue has actually increased by 46% over the last 10 years. Okay, there's a steady increase. In fact, I reckon it's actually bigger every single year, which is great. It's a great trajectory. I'd really like to see revenue increasing. It's vital, because if you don't have increasing revenue, you're not going to have increasing earnings. Okay, at least in the long run. And then finally, the operating margin of this company has been consistently high. Okay, definitely, you know, in the mid to high 30%, which is a really good signal. Okay, that means that they are a profitable company. It means that the margins are high. All right, this is a really good sign when you look at a company. So there you have it, guys. First Source Corporation definitely does seem like a pretty attractive company in general at what seems to be an okay price, maybe slightly undervalued. Okay, so in this world of Gamestop and, you know, really expensive S&P 500, you can perhaps find some value with this little known company. Now, full disclosure, I don't own First Source Corporation. Okay, I do already own quite a few other banks, so you know, I don't want to be too concentrated on banks. However, I might actually consider it, because I do actually really like what I see with this company. But yeah, guys, that was it. I really hope you've enjoyed this video. Let me know in the comments below if you'd like me to do more videos about, you know, really kind of deep dives into stocks like this one, for example. Because you know, they do take more work than other videos, because I have to do my research. There's a lot more preparation. But yeah, give this video a like, comment, share this with someone that might be looking for an undervalued stock. And yeah, make sure to subscribe to this channel if you haven't done so already. And yeah, that's all I had to say really, guys. I will see you in the next video next week, okay? Take care.